Disposal of a subsidiary and deconsolidation step by step. In this lecture, we will tackle exactly the opposite side of the consolidation process, and we will prepare three statements: consolidated statement of financial position, consolidated statement of profit or loss, and consolidated statement of changes in equity to see what happens when a group loses control of its subsidiary. I am Sylvia of cpdbox.com, and you are very welcome to check my website and courses if you want to make significant and fast progress in your IFRS knowledge. So, let's imagine a parent has owned 80% shares in a subsidiary, and after some time it sells the whole share to the third party. So the subsidiary is no longer here in the group. Now be careful, because the sale of shares itself is not the reason for disposal of a subsidiary. But we need to ask, did the parent lose its control of that subsidiary or not? So the focus is on control. If yes, so the control was truly lost, only then we need to account for the disposal of a subsidiary. But if not, and the control was not lost, only some shares were sold, then no, we keep subsidiary in the group and we do consolidate, but we have a special purpose entity. So you can have even 0% share and contractual control, but you need to consolidate. In this video, we will focus on the case when control was truly lost. So let's deconsolidate. Let's read the case first. Mummy Corporation acquired 80% share in Baby PLC 3 years ago when Baby's retained earnings were 12,000 currency units. So let's assume there was control and Mummy needed to consolidate fully. On 31st December 2006, Mummy sold full 80% share for 180,000 currency units. Again, let's assume that control was lost. Mummy accounted for non-controlling interest by the proportionate share method and no impairment of goodwill was charged. Mummy accounted for its investment in Baby at cost in its individual financial statements under IAS 27. Ignore taxation and prepare consolidated financial statements of Mummy Group at 31st December 2006. Now, we can see a bunch of statements here, namely statements of financial position of both Mummy and Baby. And then we have also both statements of profit or loss for the year 2006. So we will prepare three statements: financial position, profit or loss, and changes in equity. Please note that here in these individual financial statements, all assets are with plus and all liabilities and equity are with minus. Similarly, all revenue items are with plus and expenses with minus. Use whichever method you like. Just be consistent and think of it what you're doing. Before we start, let's summarize the consolidation procedures. So those are not precisely stated as here in IFRS 10, but they are derived from that standard. So step number 1, derecognize all assets and liabilities of the lost subsidiary at the date when control is lost. Of course, because now after loss of control, there will be just parents' assets and liabilities, right? Step number 2, derecognize any non-controlling interest in the lost subsidiary and goodwill acquired in that business combination. Yes, sure, that's also logical because we are decomposing group and all the related components must go. Step number 3, recognize fair value of consideration received from the transaction, whatever parent received from the new owners of a subsidiary in return. And step number 4, recognize any resulting gain or loss in profit or loss on disposal attributable to the parent, similarly as you sell some asset at loss or at profit. If the parent lost control and retained some share, meaning subsidiary turned to associate, just as an example, then we need to complete some more steps, but let's focus on this basic example. Let's start with the consolidated statement of financial position. Normally, when you consolidate, you just put parents and subsidiaries balance sheet next to each other, and they need to be in the same structure to aggregate, right? Not this time, because as I have already said, after disposal of a subsidiary, there are only parents' assets and their liabilities. Subsidiary is gone. So basically, Mommy's statement of financial position is consolidated one too, right? Well, if you look to assets closely, there is still line item investment in baby, which is cost of baby's shares paid years ago. And the question says that Mommy accounted for baby at cost in line with IAS 27. So we need to remove it plus recognize Mommy's gain. Let's calculate it in working number 1. The fair value of consideration received was 180,000, as said in the question. Less carrying amount of investment in baby in Mommy's financial statements is minus 100,000. And so the gain is 80,000. So we will recognize this gain and also the fair value of consideration received and removed the investment here. So let's see. We credit investment in baby with 100,000 to remove or derecognize the sold share. We debit trade and other receivables with 180,000 to recognize fair value of consideration for that share. Of course, the exact account depends on the situation. It could be bank account, but rarely, in most cases, financial settlements follows after the contract. And we credit equity minus 80,000. Remember, debits are plus, credits are minus, which is the gain. And that's it. And so, adjusted Mommy's individual statement of financial position is just its original plus this adjustment. And then this adjusted statement is the consolidated statement of financial position itself. So you can see no goodwill, no non-controlling interest, retained earnings, only those of Mommy. It's that easy. Well, let me also mention here that it is still consolidated, not individual, because that group must publish consolidated financial statements. It had control of subsidiary during the year, right? Now, while balance sheet is easy, consolidated profit or loss and other statements are not so easy. So let's prepare consolidated statement of comprehensive income, in this case, just profit or loss. Consolidated profit or loss statement is not that easy, as I have mentioned, as the statement of financial position, because this statement is not a picture at the certain date, but the report about events during certain period is like a video. So Mommy held a subsidiary during the full year of 2006, and therefore, yes, you do need to aggregate all parents and subsidiaries' revenue and expenses and eliminate intragroup transactions. And on top of it, you also need to calculate group's gain or loss on disposal of subsidiary in the consolidated financial statements. Well, hang on a minute. Isn't it the same as we calculated before this 80,000? No, it's not. Here, we calculated parents' gain in the separate or individual financial statements. But now, we are going to calculate group's gain in the consolidated financial statements after taking non-controlling interest and goodwill into account, right? So first, let's calculate goodwill at acquisition, which happens to be the same as goodwill on disposal since no impairment has been charged so far. Short reminder, goodwill at acquisition date is calculated as fair value of consideration transferred plus non-controlling interest in subsidiary. This is the part belonging to other shareholders. So if the parent acquired less than 100%, plus fair value of previously acquired interests. It's relevant when subsidiary is acquired in stages, but not applicable in this case. And minus subsidiary's net assets. So Mommy paid 100,000 for its share. We have that in its balance sheet. The second part of the formula is non-controlling interest at acquisition date, which we can calculate as baby's share capital at acquisition, 80,000, plus baby's retained earnings at acquisition, per question, that was 12,000. And so total baby's net assets at acquisition was 92,000. And non-controlling interest share was 20% because mommy acquired 80%, remember? And so 20% of that is 18,400. That was the second component. And we also need to deduct baby's net assets at acquisition, which we just calculated, minus 92,000. So the goodwill acquired in this business combination was 26,400. The question says that no impairment has been charged so far, and so we can use it in the calculation of the group's gain on disposal. Let's do this in working number 3. Fair value of consideration received for the shares was 180,000. Less group's share on baby's net assets at disposal. And actually we need to calculate it. So these are baby's share capital at disposal, 80,000, plus baby's retained earnings at disposal. We can see that from baby's balance sheet, 36,700. And so total of baby's net assets at disposal was 116,700. And then group's share of 80% is 93,360. Less goodwill, which we calculated in working number 2, minus 26,400. And so total group's gain on disposal is 60,240. Fine. We have done most of preparations for our consolidated profit or loss, and let's do it in 3 steps. The step number 1 is to aggregate the amounts of revenue items and expenses of the parent with the similar line items of revenue and expenses of a subsidiary. So we are just going to combine them, but let me warn you here. You will do so from the beginning of the reporting period until the date when the control was lost. I am talking about subsidiaries items. And that's logical because in that period, all those subsidiaries' revenue and expenses belonged to the group. So let's combine here. In this example, it's simple because the question says that the sale happened on the last day of the year, and so all revenue and expenses are consolidated. If the sale happens in the middle of the year or at any other date, normally the subsidiary would be required to prepare additional financial statements at that date in order to perform consolidation properly. And I know that in the exam, you can be given something like the sale happens on 31st July. And so you would need to calculate revenue and expenses in year proportion, right? But this is not the way it's done in practice. Fine, we have our combined numbers here. The step number 2 is to eliminate intragroup transactions. Here we have none due to simplicity, so we are not going to do that right now. But be careful, again, you do this only for the period with control. The step number 3 is to recognize the group's gain on disposal of a subsidiary. And we have already calculated that gain in working number 3. So let's bring it here to our statement as a separate line item. And as I mentioned, it's not the same as the gain in the balance sheet above because in fact you are also removing goodwill, non-controlling interest and other items which we did not show here because we did not aggregate the balance sheet. But I promise you will get the proof that everything is in order. Now, let's prepare the consolidated statement of profit or loss by adding up the combined numbers and our adjustment for gain, Of course, you would also add those eliminations of intragroup transactions and other items if there would have been some. And yes, we have our nice consolidated profit or loss statement for the period since the beginning of the reporting period until the loss of control. And also for the year, right? One more thing. It's necessary to prepare the breakdown of the profit for the period and state what part is attributable to the owners of the parent and what part is attributable to non-controlling interest. So, to the owners of the parent, we attribute full mommy's profit and 80% of baby's profit and also the full profit on disposal because that profit belongs to the owners of the parent. To the non-controlling interest, we attribute just 20%, which is percentage of non-controlling interest of the baby's profit. Now, let's also prepare the consolidated statement of changes in equity to see if those numbers in the balance sheet and profit or loss statement actually make sense. Here we have a blank statement for the period starting 1st January 2006 until the year end, and we know the share capital. It's the same as mommy's share capital, and there was no movement during the year, so we can just enter it right away. However, we do not know the consolidated retained earnings and non-controlling interest at 1st January 2006. Normally, you know this in practice because you can just look to your financial statements. But for this example, let's do two more calculations. First, let's calculate consolidated retained earnings on 1st January 2006, and we will do it backwards, so we will do sort of rollback. Basically, it's mommy's retained earnings plus group's share on baby's retained earnings. So let's focus on mommy's retained earnings first. So mommy's retained earnings at 31st December 2006, and we can see this in its balance sheet, are 62,000 currency units. Less mommy's profit for the year 2006, it's 13,000. So we get 49,000 at the beginning of the year. Now, group's share on baby's retained earnings at 31st December 2006, it's baby's retained earnings at the end of the year. Again, we take this from the balance sheet, 36,700. Less baby's pre-acquisition retained earnings, and this is said in the question, and we need to deduct it because pre-acquisition retained earnings enter into the goodwill calculation, so they do not belong to the group's retained earnings. That's basic consolidation rule, and it's 12,000. And less baby's profit for the year 2006 per question or per profit or loss statement, 7,370, and it gives us baby's retained earnings, post-acquisition retained earnings of 17,330 at 1st January 2006, but we need to take only group's share of 80%, which is 13,864. Add those two numbers up and we have calculated that consolidated retained earnings in the beginning of the reporting period are 62,864. Let's bring this number to our statement of changes in equity. Fine. We also need to calculate non-controlling interest at 1st January 2006, so let's do this in working number 5. This time we are not doing rollback. We tried to do it from non-controlling interest at acquisition, which we calculated earlier in goodwill calculation, and that was 18,400. Then we need to add non-controlling interest share on post-acquisition retained earnings of baby, which is baby's retained earnings at 1st January 2006. Those are post-acquisition retained earnings only. And we have just calculated it in working number 4, 17,330. And we apply non-controlling interest share of 20%. So we get 3,466. So total non-controlling interest brought forward at 1st January 2006 is therefore 21,866. And let's bring that into our consolidated statement of changes in equity. Fine, we have these nice opening balances, so let's tackle the movements. As I've said, no movement in share capital. Retained earnings changed because the group earned profit for the year until the loss of control date, and that was 79,136, and we take just group's share, so attribute to the owners of the parent from consolidated statement of profit or loss. Non-controlling interest also changed. First, a part of this year's profit increased non-controlling interest by 1,474. So we take that from the above here. And then we need to eliminate full non-controlling interest because the subsidiary was sold and there is no non-controlling interest at the year end after loss of control. And so we just eliminate it all. The last column are just horizontal totals. So let's check vertical totals, which are our closing balances. Share capital is share capital of mommy, no change here, okay. Retained earnings come to 142,000 and moment of truth. This should be the same number as in the consolidated statement of financial positions, so let's check that. You see? Great, all good here. Non-controlling interest is 0 because we have eliminated it. And the total of the consolidated equity is 342,000. Again, check that with your balance sheet. Great, all good. So this is it, full deconsolidation step by step. Please give me a like if this video was useful. And if you wish to learn more, much more, check our website for the free newsletter and other materials. Thank you for watching. Bye.